Our guest today at MoneyShow is Peter Staas, editor of Capitalist Times. Thank you for joining us.
Thanks again, Zach. It's always great to talk to our friends at the Money Show.
Could you give us an overview of your investment strategy?
Sure. We run 3 investment newsletters. Our generalist publication is Capitalist Times, and that's kind of a go-anywhere strategy. Elliot Gu runs our Wealth Builders portfolio, which is focused on our best growth ideas across multiple sectors. Roger Conrad runs our income portfolio, which is seeking superior total returns with above average current income. And then we also have Energy and Income Advisor that's focused on the energy sector, and we cover every energy-focused master limited partnership in that publication. That's headed by Elliot Gu, who's covered the energy space for more than 15 years. And then we have Conrad's Utility Investor, which is focused on the utility sector. Roger has covered that space for more than 30 years, and he has amassed an impressive track record over that period, the long term and the short term. So those are our products. Check them out.
At the start of the year, you chose Fomento Economico Mexicano, known as FEMSA, as your favorite stock for 2017. Since then, the shares have risen 27%. Could you explain the original rationale behind choosing this stock?
Yeah, sure. There were a number of factors that we considered. Probably the biggest one was kind of a macro call. There was a sell-off in the Mexican equity market and the peso after Donald Trump's election, and we thought that gave investors a good opportunity to buy what we would consider high-quality Mexican stocks at a discount. So that was the macro call. But we also like Fomento Economico Mexicano's business. We like the synergies between its equity interest in Coca-Cola FEMSA and its retail operations. Coca-Cola FEMSA, they bottle and distribute a wide range of branded beverages in Latin America, and that business accounts for about 13% of Coca-Cola's global volumes. That business throws off a lot of free cash flow, and Coca-Cola itself is trying to double its revenue by 2020, and so we think Coca-Cola FEMSA, the bottling business, should benefit from that, resulting in more free cash flow for Fomento Economico Mexicano. And FEMSA, what they do is they plow that free cash flow from their bottling operation into their retail segments. And that business, that's about another half of its revenue. They have 3 retail segments. The largest one is OXXO, which is their convenience store business, and that's extremely well run. Those locations offer a wide range of services, from you could pick up your Amazon orders there. You could buy bus tickets. I mean, there's a ton of stuff. Really well run, very solid. Some of the best margins in the convenience store space, and you have a lot of headroom to expand. They're looking to open 1,200 locations annually over the next 8 years. The southern part of Mexico isn't as well penetrated, and they're also seeing opportunities to open locations in hospitals, factories, other non-traditional places. They've made some acquisitions in Chile and Colombia, and that gives them a growth platform to expand their convenience store business there. They've also moved into drugstores in recent years. They've got more than 1,000 locations in Mexico. They're the 4th largest operator in that industry, and that's a space that's ripe for consolidation. Just a highly fragmented space. And then you've also got their gasoline retail business is much smaller, and you've had a deregulation in Mexico's energy industry, and so that could create an opportunity for them to expand there. In terms of funding all that expansion, the company also owns a 20% equity interest in Heineken. Management team kind of views that as non-core, and I think we could see them monetize that at some point in the future and plowing the proceeds into acquisitions that would complement the company's existing retail platforms and, would give them added scale. So we saw a lot of, not only did we see it make a macro call, but we saw a lot of intermediate term to longer term upside drivers for the company. So that was the basic call there.
Could you share an overview of developments at FEMSA since the start of the year?
Sure. Well, I think for people that followed our lead on this, probably the most important thing is that the stock has done really well, and I think a lot of that validates primarily our macro call. The company's first quarter results fell short of the consensus earning estimate, primarily on higher expenses related to new store construction and some other expansion efforts, but the base business continues to grow at a steady clip. OXO, the convenience store segment, had revenue growth of 12% year over year. Slight contraction in margins there, which again is because of the build out. Drugstore operating cash flow is up 18%, so really impressive performance there. So I think our basic investment thesis is intact, and we still like the stock over the long term.
So given the stock's strong performance so far this year, do you still recommend it as a buy?
Yeah, we still like the stock as a long-term holding, but people that are up 25, 26% from when we highlighted it for the MoneyShow, they might want to take a profit off the table and let the rest ride. It trades at a pretty full valuation, like a lot of so-called platform companies. I think part of that is we just see better opportunities for near-term upside elsewhere in the market. For people who might be looking for more international exposure, we like Telefonica. The ticker is TEF for the American Depository Receipt. And that trades at what we regard as a favorable valuation, and it offers exposure to a compelling turnaround story. The company cut its dividend last year, and that enabled it to shore up its balance sheet. It's made a lot of progress there. We see the potential for some asset monetizations to kind of accelerate that balance sheet repair process, which would then position the company to resume dividend growth. We also like the underlying business, which continues to perform well. Telefonica has the industry-leading wireless network in Brazil, among many other assets. They've continued to take market share while a lot of their competitors have sort of reined in spending because of the challenging economic conditions there. So we think it's a compelling turnaround story. You get a decent yield, and you see the potential for a resumption of dividend growth, which would be a big upside driver for that stock. So if you're looking for something to put your, the profit you made on Fomento Economico Mexicano, Telefonica might be a good choice for you. So.
This is Zach Levine with MoneyShow, and we've been speaking with Peter Staas, editor of Capitalist Times. Thank you for your time.
Thanks again, Zach.